And that's when my perfect ascending triangle on Bitcoin just fell off a cliff. Proper nosedive, bro.
Wow.
I'm talking a -5% candle out of nowhere. The pattern was clean, the volume was there, everything was looking peng. And then, poof, rinsed.
Let me guess. You didn't check the calendar, did you? You were so busy drawing your little triangles, you forgot it was CPI day.
CPI, SHMPI, it's just numbers in it. It's all priced in. The charts tell you everything.
Right.
That's the first thing they teach you.
It's all priced in. Man, those are the four most expensive words in trading. Fam, you sound like one of these new crypto gurus who think the real world doesn't exist.
Okay.
The charts don't tell you everything. They tell you the story of what's happening. The macro data, that's the plot.
Right.
You're trading to read a book by only looking at the pictures.
All right, allow it. Don't get all Canary Wharf on me. So you're telling me some geezer in a suit reading a number off a piece of paper is more important than a multi-week support level?
More important? No. But does it have the power to turn that support level into a wet paper bag? Absolutely.
Okay.
And that's what we're talking about today, isn't it? This is like proper CMT level 3 stuff, the fusion, how the big picture, the macro stuff, shapes what we see on our charts.
Okay, I'm listening.
But make it make sense for a degen like me.
Yeah, no long-winded economic theory. Give me the street smart version.
Simple. Think of it like this. The macro environment is the weather. Is it sunny? Is there a hurricane coming? Technical analysis is your map.
Right.
Your map can be perfect, showing you the quickest route to the pub. But if there's a hurricane, your map is useless.
Yeah.
You're not going to the pub, you're getting blown away.
A hurricane. So CPI data is a hurricane?
It can be. Look, there are 3 big ones you absolutely cannot ignore. First, you got inflation data, like CPI, the Consumer Price Index.
Right.
That's basically the government's way of telling us if the price of a pint, a Freddo, and your rent is going up. If inflation is running too hot,
Yeah.
the central banks get twitchy.
And when they get twitchy, they hike interest rates. And when they hike interest rates, my Bitcoin bags get heavy. I get that bit. Money gets expensive. People have less to throw into risk assets like crypto.
Exactly. So your beautiful chart pattern might be screaming bullish breakout. But if CPI comes in way hotter than expected, the market suddenly isn't thinking about your little pattern.
Okay.
It's thinking, oh snap, the Fed's gonna hike rates into oblivion. That's a new weather forecast. The hurricane warning is out.
Right.
All the buy orders evaporate and the sellers come out in force. Your breakout becomes a fake out and you're left holding the bag.
Okay, that makes sense.
Right?
The data changes the mood of the market, the sentiment.
It's more than mood. It changes the regime, the entire set of rules. For the last 10 years, the rule was buy the dip because money was cheap.
Yeah.
Central banks were printing money like it was going out of fashion. That was the weather. Now, with high inflation, the weather has changed.
Okay.
It's a sell the rip environment. The whole game is different. So when you see a dip, you can't just blindly buy it like you did in 2021.
Right.
You have to ask, is this a dip or is it the start of a cliff? The macro data helps you answer that.
So CPI's one. What are the other big dogs?
Next up is employment data. In the US, it's the non-farm payroll, or NFP.
NFP, right.
Every Forex trader lives and dies by this number on the first Friday of the month. It's basically the answer to how many people got a job last month.
Why does that matter so much?
Well,
If people are working, isn't that just good?
it is, but it's about the implication. A super strong jobs number means the economy is running hot. People have money, they're spending, which can push inflation up. So a strong NFP can be seen as bad for the market.
Right.
Because it gives the central bank a green light to keep interest rates high, to cool things down.
So good news is bad news. That's messed up.
Welcome to macro trading, bro. It's all backwards. Conversely, if the jobs number is really weak, the market might rally. Why?
Why?
Because it thinks the central bank will have to cut rates to stimulate the economy. Cheap money might be coming back. The punch bowl might return.
Wow.
So a weak jobs number can cause a massive pump even if the underlying economy is getting weaker.
So you're not trading the number, you're trading the market's reaction to what the central bank might do because of the number.
Exactly.
It's a multi-level chess game.
You're getting it now. And the final piece of the puzzle, the big boss, is the central bank itself. The Fed in the US, the Bank of England here, the ECB in Europe.
Right.
When the governor speaks, everyone shuts up and listens. Their statements, their interest rate decisions, that's not just data. That's them telling you the rules of the game for the next 6 weeks.
Right. I've seen Jerome Powell speak and watched Bitcoin dump 10% in 3 minutes because he used the word pain.
Exactly. He could have said anything, but the market heard, "We're going to keep hiking until you all lose your jobs and your crypto is worthless." His tone, his language, it sets the entire risk tone.
Yeah.
If he's hawkish, meaning he wants to fight inflation with high rates, your technicals for risk assets like stocks and crypto are on hard mode. Every resistance level is like a brick wall.
Wow.
And he's dovish, meaning he's open to cutting rates. It's easy mode. Every dip is a gift.
So let's bring it back to the charts. How do you actually use this? Let's say I see a perfect head and shoulders top forming on the S&P 500.
Okay.
It's a classic reversal pattern. But Powell speaking tomorrow, what's the move?
Great question. This is the fusion part. A pure technical trader would just see the pattern and short the neckline break.
Right.
A macro trader would be waiting for Powell. The smarter trader, the CMT level 3 trader, combines them.
Go on.
You see the head and shoulders. That's your thesis. The market structure looks weak. You've got your map. Now you look at the macro event, Powell's speech, as the catalyst.
The catalyst, yeah.
If Powell comes out super hawkish, confirming your weak thesis, that's your green light. The hurricane is making landfall exactly where your map said the weak spot was. You can short with much higher conviction. The pattern is now validated by the macro.
And what if he comes out dovish, saying they might pause rate hikes?
Then you stay the hell away from that short. Or you even consider that the head and shoulders is about to fail spectacularly.
Okay.
A dovish pivot would invalidate the bearish thesis. The price could rip right back up through the pattern.
Wow.
And all the people who shorted based on the pretty picture get liquidated. You've just used the macro data to avoid a massive trap.
Okay, so the pattern gives you the where, and the macro gives you the why and the when.
Nailed it.
It's about context. A chart pattern in a low volatility dovish environment behaves completely differently to the same pattern in a high volatility hawkish environment.
Right. Macro tells you what environment you're in. It helps you filter your technical signals.
Okay.
You stop taking every single setup and start focusing only on the ones that are aligned with the big money flow.
I can see how that works for stocks and Forex, but what about crypto?
Aha.
We have our own macro, don't we? Like the Bitcoin halving, or an Ethereum upgrade, or even some mad tweet from Elon Musk.
Yes, that's a perfect way to think about it. The Bitcoin halving is a macro event for the crypto world.
Yeah.
You know it's coming. So as a technical trader, you'd be a fool to ignore it.
Right.
The run up to the halving, the post-halving price action, that's all driven by this known macro event. Your technical analysis has to be viewed through that lens.
So if I see a bearish chart pattern forming a month before the halving, I should probably be a bit skeptical of it.
Exactly.
Because the overriding macro narrative is bullish.
100%. The narrative is your tailwind or your headwind.
Right.
Why would you try to short into a narrative-driven hurricane? You wait for the chart to align with the narrative. You look for bullish continuation patterns. You look for dips to buy. Because the macro weather is sunny. You're putting the odds in your favor.
This is actually making a lot of sense. It's not about abandoning the charts.
No.
It's about making them smarter. It's a filter.